So this session, like I said, is called Smart Money Moves. This is about progress, confidence, and control. So the first thing I want to talk about is managing your debt smartly. Understanding debt, I think, is really, really important. Key messages with as far as debt is concerned is debt is a tool. And it's unmanaged debt that makes us stressful. And so the different types of debt that I'll be talking about: credit cards, which typically have higher interest rates, auto loans, student loans, medical debt, personal loans, and mortgage debt. That's probably the biggest debt that most of us have. Not all debt is bad debt. There's good debt and then what I call stressful debt. So healthy debt, and the reason I call these healthy debts is because they do add value to our lives. Having a mortgage means that you've purchased a home. Education, student loans, even though some of them can just overwhelm us, the point of student loans is to better your life, through education. And then business investments. The ones that I don't consider healthy debt, and I consider them high stress debt, is high interest rate credit cards, payday loans, and of course, collection accounts. We don't want, nobody wants to have collection accounts, but sometimes that happens. And those debts I consider to be stressful debt. Again, this is all about clarity. So it's really, really important that you know your numbers. I highly recommend that you make a list of all your debts. I would put it in a spreadsheet, all your debts, what the balance is, what the interest rate is on each debt, what the minimum payment is, and what the due date is, and total it up, because awareness reduces anxiety. So once you've got all that figured out, then you want to make a plan to pay off your debt. And there's three main strategies for paying off debt. The first one is the snowball method. That method is you pay off the smallest balance first. The benefit of that is it builds momentum and it motivates you. The avalanche method is, that list I had you make of all your debt and the interest rates. You start with the highest interest rate debt first, and you pay that debt off. And then once that's paid off, then you pay the next one off. Debt. The hybrid approach is kind of combining both together. You would look at all your debt, and maybe a small balance has a high interest rate. Yet how can you reduce the interest, and how can you reduce your payments? And one of the first things that you can do, and a lot of people don't know that you can do this, is you can negotiate interest rates. The other thing you can do is balance transfers. Now, be careful with balance transfers. You'll get a card in and it says 0% interest. And sometimes that 0% interest is only for 6 months, 9 months, or whatever it is. Well, if you open up a new account, which will, when we get into credit, shortly, when we look at your credit scores, that could hurt you if you keep opening up new accounts and transferring balances. But if the balance transfer, the low interest rate is, say, good for a year, or zero interest rate, it might be worth it. You just have to weigh whether it makes sense. I know some people that constantly do it, and their scores, fluctuate because they're having hard inquiries every time they do a transfer to a new account, because doing a balance transfer means you're opening up a new bank account. New credit card, I'm sorry. And so you want to pay attention to that. Number one, is it worth it? Is the interest rate going to be zero, or what is it going to be? And how long is that zero rate or the lower rate good for? That's important to read the fine print. The other thing that you can do is a debt consolidation loan. Be careful on this, because I've run into people who consolidate debt and then they go back and charge up all that debt again. Then there's hardship programs. You can call the credit card companies if you are facing a hardship. They may ask you to document it. It could be a medical reason, or a lost job, or reduced working hours. Any of those things could be a reason for them to consider a hardship program. And sometimes with hardship programs, they'll waive the interest or they'll reduce it quite a bit. And then there's nonprofit credit counseling companies. These people will negotiate with your creditors for you. The downside is it is a negative impact on your credit report. And lastly, medical bills. That would be the last bill I pay because it's not going to impact your credit score. I mean, payment priorities during hard times. If you have a mortgage or rent, you're going to pay that first. And then, of course, your utilities, then food and transportation, then secured debt, and then credit cards. Always pay your house first. So you want to build and maintain good credit. That's the key. And so why does the credit even matter? Well, number one, if you're trying to buy a home, it could make a difference, your credit score and your debts. If you're trying to rent an apartment or a house, most landlords are going to run your credit report. And some people don't know this. Bad credit impacts your insurance cost. And car loans are going to be way more expensive if your credit isn't good. And then lastly, employment screening. Certain jobs care about your credit. And bottom line, strong credit saves you money. You're going to get a better interest rate on everything if you can build a strong credit record. So payment history equals power. So if you try to pay on time every time. Set up auto pay or reminders. One late payment can drop your credit score significantly. And what I mean by late, not 1 day late, 2 days late, 3 days late. It's when you're 30 days late. And one 30-day late can drop your score like 30, 40 points. So credit utilization, this is important. You always hear people say, don't charge more than 30% of your credit limit on a credit card. So let's say your credit limit is 1,000 and your balance is 300, then you're at 30%. That's good. But if you can keep all of your balances at 10%, that's an even better credit score for you. And that's excellent credit utilization. And under 5%, you're elite. So work towards that. Smart credit habits. You want to keep all your old accounts open. And again, avoid closing any, but you definitely want to close your oldest card because remember I said the length of your credit history impacts your credit score as well. So the longer you've had credit, the better your score will be. And try to limit hard inquiries. Hard inquiries hurt your credit. And I would say only apply for credit when you really, really need it, and monitor your credit reports regularly. So here's free ways that you can monitor your credit. Annualcreditreport.com. You're allowed to get one free credit report a year, free. Some credit card apps that if you have a credit card, sometimes they'll monitor your score and they'll tell you what your score is. And then there's credit monitoring services, and like Credit Karma. And there's other ones out there. Equifax. Okay, so ways to improve your credit fast. Number one, paying down credit card balances. That's the fastest way to improve your credit score. Number two, look at your credit report, and if there really are errors on your report, dispute them with the credit bureaus, and if they're legitimate, they'll remove them. Another way is become an authorized user on someone's card that is got really good credit. But keep this in mind. When you become an authorized user, you need to make sure that they don't max out that credit card. Because anytime they do that, boom, your credit is going to be hurt. But if you have a parent or a child or a relative or someone that you really, really trust that has good credit, you can ask them if you could be an authorized user on one of their credit cards. And you can get your credit and especially if it's a credit card that they've had open for years and years and years, then that goes on your credit report as an old debt, which is good. And if it's been paid on time for all those years, you're going to see a nice little boost in your credit score. But you got to monitor that because, you need to make sure that person is trustworthy because they need to let you know if they're planning to max out that card because that can hurt your score, So the other thing you can do is you can request the credit card companies to increase your credit limit. So let's say you're maxed out at 1,000 and you've been paying on time. You can call them up and say, hey, can you make my limit 1,500? And that way you're not so maxed out on your card. And most of the time they'll do it if you've been paying on time. But you want to avoid maxing out credit cards. And doing any of these things can improve your credit in 30 to 60 days, just that fast. You can see better credit scores. Plan for your future. Financial stability equals peace of mind. Planning is really, really important, and we forget that. And Leon will be talking more about that. That's his area. But financial planning is all about security, freedom, and having to be able to have choices in your life. When you plan ahead, you reduce stress and you increase stability. Even small steps that you take today can create powerful results over time. So here's a 7-day financial reset that I recommend for this week if you want to take action immediately. You wanted to follow, like I said in the beginning, list all your debts and the interest rates on those debts. Get a copy of your credit report and go through line by line by line to make sure there's no errors. And if you find errors, reach out to the credit reporting agencies to get those errors set up. Set up auto pay. Again, I'm not a big fan of that, but you can also do reminders. You can put your debts on your calendar if you do run into forgetting to pay them and you don't pay them on time and you end up paying late charges. Put them on your calendar every month so that way that it pops up and it reminds you that you need to pay this bill on this day. And start saving, even if it's just $20, $100, if you start that savings account. And then lastly, track your expenses, track your income and track your expenses. We covered that the last time. And then here's your 90 days. So that was your 1 week, your 90-day transformation. Reduce credit utilization, build up a savings account, even if it's just $500. Work on improving your credit score, which credit utilization will definitely work on that, and lower debt stress. And in the end, you're going to feel more in control. If you need help, it's okay. It's okay if you need help. Reach out to people like me and Mickelin. And then if it looks like your whole situation is just beyond what we can help you, we'll have some suggestions for you.
When you're looking at retirement, you look at the retirement in the center, there's a lot that goes on that's involved. You're maybe concerned with the markets. What's it going to do with the money that you have saved up? What are the tax implications? Do you have accounts that are taxable? Do you pay taxes on that money? Longevity, how long are you going to live? Of course, we don't know the answers to many of these things. And some things we can control and have some influence on, and others we can't. Will you continue to work? Or when you're working, how does that play into the aspects of retirement? When it comes to asset allocation and location, to bring that down in plain English, are you conservative with your money? You don't want to see it moving up and down too rapidly, or you're comfortable with it moving up and down rapidly because in the long run, hopefully there'll be more of it. How much did you save and how much are you going to spend? All right. You got to determine when you're going to retire, right? And so what your purpose is going to be, how you're going to socialize, your health, those things are more or less, well, they're connected to the financials, but these are questions that may come to mind, and you also want to incorporate this into your financial planning process. Income replacement needs may vary by household income. So depending on how much you made when you were out working, you have to think about, well, what will that income look like when I'm in retirement? And so your pre-retirement income may not necessarily be the same as your retirement income. You can see the green line is Social Security. Amounts required from private employer sources is the blue, and then change in expenditures, taxes, and pre-tax savings. So retirement checkpoint savings, we used this slide last week. And this kind of gives just a heuristic. If you're taking annual gross savings, if you're saving about 5% and inflation is about 2.5%, you want to retire at age 65, and you want to spend 35 years in retirement. Sometimes I'm talking to individuals, so this just continues into different household income and age. And we do want to focus on consistent investing. because that's really what helps to build these accounts over time. So the amount of growth of $250 invested saved monthly, and you look at these different scenarios. So the early and consistent investor has the best results. The early investor who stops after 10 years does slightly better than the late investor who invests significantly more over a longer time. So tax implications, that's always a concern for retirement savings by accounts. Some of this may be a review to some of you, it may not. So when your pre-tax savings, your 401k, a traditional IRA, that money you get to write off on your taxes. So for a Roth IRA, a Roth 401k, the Roth account is really helpful when you retire because you don't have to pay taxes on that money. You pay taxes now, it grows tax-free, tax-deferred, you're good to go. After tax 401k, we won't have to get into that one. It's just extra money you put in if you're able to make all the matches and the contributions and everything. You want to put in more money up and beyond that, you can, and it's helpful to you. Health savings. If you have a high deductible plan and you're a small business owner or you work for an employer and you have a high deductible plan, you can have an HSA account because it's pre-tax money that you did not pay taxes on, and it grows tax-free. And if you wait until you're age 65, you take it out, you pay no expenses, no taxes as long as you use it for medical expenses. So it's a way to build another type of retirement account. Okay, well, this basically kind of showed a little bit of what we talked about before, the various types of savings accounts that you're going to have. So we're now setting up the types of accounts, and then we'll talk more about what goes into these accounts with regards to, making your money grow. So prioritizing long-term savings, if we look at some of the things that just talked about that, start with emergency reserves. Then we want to do the employer plan. We want to focus and move up to paying down high interest loans. The HSA account, if you qualify for health savings. You want to have additional defined contribution savings. Sometimes different companies may offer additional plans you can put more money away. This just shows basically as you get older, your debts should decrease as percentage of your net worth, and your income should improve. Here's the 4% rule. So the number of years you have in retirement, if you take 4% out, you start at $1 million, you still have money 35 years later. Okay, so let's switch into the investment. And I'm talking about cash, talking about stocks, talking about bonds. Range of stocks and bond blends. And bonds are basically instruments that pay interest. They're considered lower risk than stocks. Investing, we want to make sure that you have a mix of stocks and bonds. The thing is, how much is going to work for you? Do you want to have more bonds? Do you want to have more stocks? And again, it depends on your risk. So the different types of investments, again, there's cash, not highly encouraged for more long-term. This is more short-term. This is your emergency fund, or the growth stocks, international stocks. Private equity is something that's come online more recently to the retail investor. We don't have to focus too much on that. And then you see bonds. You have all your money, most of it invested, more growth oriented, more stocks, less bonds. But then you shift into retirement, you see how the bond section increases quite a bit. Social Security, most people probably pay into it, some don't for whatever reason or not. There are different times when you want to consider taking the benefits. That is specific to the individual. That's all Social Security, Medicare. Age 65 is when you get to claim. You apply for Medicare if you're no longer working. If you're still working and you're covered by a employer plan, you basically keep that plan. So the purpose of all this is savings, discipline, planning, and enjoying your life while you're at it. We don't want you to save everything and then, I saved all this money and I really didn't enjoy my life throughout the course of it. So having a good balance, but making sure that you're saving enough to meet what you want and what your goals are and the things you want to accomplish. Long-term care, that's part of the review when you're working with folks considering retirement and planning for retirement. There are lots of different types of models and things. It's expensive, but we see if it fits into your overall goals and plans. I want to end here because I want folks to have a chance for questions.